And we are back with one of the most anticipated DeFi panels in this conference, in the history as well. Not gonna lie. So, first, I want to call to the stage our moderator. You know him as the captain, but we call him as our sweetheart. Welcome, Captain Nemo. Next up, one of our panelists comes from the local company, which we all know and love, called DeFi Saver. Please welcome Nikola on the stage. Next up, we have one of the biggest OGs in the DeFi space, Bryce from Liquity. So next panelist, you probably know her, if you are deeply in the space, as all of you are, of course. Please welcome Daria from 0x. And finally, a company that supported this event so much in so many ways. Please welcome Primož from Block Analitica. I'm gonna leave Captain Nemo here, otherwise I'm gonna abandon the ship. Good luck.
Thank you. Okay, hi everyone. So first of all, let's start with a basic question. Can you just raise hands how many of you use the lending protocols in DeFi such as Aave and Compound? Just to sense the room. Okay? How many of you tried decentralized exchanges such as like Curve, Uniswap, Sushi, so on and so forth? How many of you ever use Bridge from L1 to L2? Okay, nice. Okay, so majority of the crew here. Nice. Okay, so let's start with the easy things, right? So like, can I ask you guys to just give us like a short intro about like what you're working on, what's your project about, and then we can dive into the other questions. Okay. So we can start from here.
Yep, thanks. My name is Nikola. I come from DeFi Saver, and I'm basically doing the ecosystem research, trying to figure out which protocols should or should we not integrate on our platform.
Thank you. Bryce?
Hi, I'm Bryce. I work with Liquity protocol, and yeah, my main focus around liquidity strategies and cross-chain for our two tokens, LUSD and LQTY.
Oh, okay. My name is Daria. I'm business development lead from 0x. I've been with the company for about a year and a half, and 0x itself focuses on DEX aggregation and smart order routing, so basically swaps for you. So if you ever use Matcha, XYZ, for example, this is 0x, or if you know, like, obviously you probably have MetaMask as well, we are one of the providers under the hood who powers swaps in there.
Hi, I'm Primož. I'm founder of Block Analitica, and we provide risk parameter proposals for MakerDAO, and we also build customized risk dashboards for MakerDAO, but also other DeFi lending protocols.
Thank you, guys. Okay, so first, because the whole panel is like navigating the risk and discussing what are all of the things that we survived, not just in the last 12 months, but maybe even before that. And with that in mind, I think let's start with addressing obvious elephant in the room. So I'll start from Bryce. And can you tell us a bit more, like, how do you see, like, in the last 12 months, like, we have FTX collapse, right? We have Trial Capital. We had also systematic risks such as Terra and Luna ecosystem. Can you tell us, like, a bit more about that, like, how it was, like, during building all of these things, how the perception went there?
Yeah, so definitely there was a lot of events happening related to risk last year. Pretty much a year of market trauma, if we're honest. And, you know, a first perspective is first, it's kind of good because it's a stress test of the system. So we had quite a few events in a row that were, you know, considered a black swan level, like USDC depigging or things like that. And so this kind of allowed us to see what happens actually in DeFi when those things not exactly blow up, because USDC didn't go to zero, but still depegged for like 3 days, as well as other stable coins. So I would say that's the first thing, is kind of the stress test angle. Of course, sympathy for people who lost money and all of that. I'm talking about system perspective here. The other thing that is interesting, I think, is we realize counterparty risk exists in crypto, and we were it was a bit of a big black box for everybody. So what I mean by that is, as Terra, FTX, and others blew up, they took with them in their fall many other companies, projects, and whatsoever that were lending them money or had various kinds of relationship with them. And at least for me, the big surprise was seeing those loan terms and agreements, because some of them actually leaked, and it's actually insane to see. It's pretty much like a piece of paper. Hey, give us $750 million. We might give it back to you in 15 days if you ask for it. All right, bye-bye. And money moves on, something like that. So that was quite surprising, yeah. So I guess that would be the two takeaway, like stress test.
Yeah. Do you see like in your eyes the difference between these actors, right? Because Terra Capital was a fund that majority got wrecked. FTX was, well, for the better word, fraud. And then like we had Terra Luna that was more systematic risk. Like, so how do you perceive, like, do you see the differences between these actors in your opinion, in your eyes, or?
Well, I mean, I'm more surprised about how many people got committed with these actors, despite all the factors being available publicly to assess that they were not reliable and to be trusted. Be it Terra, be it Sam from FTX. So for me, it's more about, and this is what I say to people, people say like, oh, I'm not trading the markets because the VCs are so good, they have alpha. Well, look at the VCs. They got Terra straight in the face, and most of them got FTX right after. So if you, as a private investor, avoided Terra and FTX, you are beating 99% of the VC in terms of risk management.
Valid point.
I would like to add that probably the most important difference between those actors is that for Terra, for example, we had everything transparent and there on chain, so everybody could look at the code, and it was surprisingly to see, so much people taking the risk for that 20-something% APY, because it was, I would not say obvious, but if you can, if you have, let's say, gone through a lot of DeFi protocols, finding the flaws in design, I think, should not be that difficult. And I think in case for Terra, it was not. So I think that people who are in the industry, who were in the industry for some period of time, knew that the protocol was, not sustainable by design, and I think that was the difference. You cannot see that because of the no transparency existed for the other actors. But yeah.
It's interesting, and actually, maybe you can start, and then I would like to hear from Daria. Interesting thing that is happening is, like, maybe some of you know already, but Terra Capital is managed to raise a new round to start some new project and so on and so forth. So from the perspective of like these all new actors that caused the market crashes and lost billions of dollars, how we can as a community actually prevent these things from happening, and is it on us, and how we can authorize the bad actors more effectively. And with that in mind, do you see the world where these actors become net positive in your eyes, or in the eyes of the crypto space? You can start and then...
Okay, well, I think that the focus here should not be on them raising money again. I think that we as a community should focus on users in terms of education of what has happened previously, and explaining those events, explaining how and why did they happen, and to react by providing some non-custodial solutions and maybe improving the UX of managing your own funds, and trying to bring the transparency into the world of finance. So yeah.
But we already somehow we already have like tons of protocols that are transparent and everything. And as you guys mentioned, still people expose themselves to the risks. Doesn't matter if it's centralized or decentralized. The human society as a whole and the greed level that we as humans have is something that is constantly influencing people. So do you see the world where we as the crypto native, quote unquote, DeFi world, somebody that cares about ethos, do you see the world how we can actually help out more and in which way to, I don't know, educate people or help them out to not go there, even if it's like 20,000 APY or something like that?
Okay.
Yeah, Daria, you can
I want to maybe add slightly different perspective here. So I know the people were talking about, they hurt a lot of like users, and I totally support the education part because again, but I have a question about these people who like committed these like actions. Are they really bad people? Or are they like bad entrepreneurs? Because like in startup world, like everybody knows it's like mantra, 95% of startups fail. In crypto, probably even more. So the question, like their next startup, do they have a right for it? Because basically lots of like thousands or even millions of people lost their money, and can they like basically recoup their like sins with this new venture? Or like should we just punish them as a community, tell like basically like in centralized world where some bad actors are not allowed to go into industry anymore? So like this is like a question for me still, and I think this should be decided by the community, and community should be much more well educated to make these choices on themselves and to assess this risk. So if this guy is like convicted criminal in the past, can he still be like good in his next action, and how much of risk I'm willing to take it? Maybe not all my savings, probably. So this is my take here.
Fair. Bryce, it feels that you want to add something there here.
Yeah, I both agree and also disagree a bit, where I think it's a matter of self-policing, essentially. So if you think about every industry, they usually don't self-police because they have regulation falling on their face. Here, we neither have really regulation in the terms of, you know, those guys, like they're not in jail, they're sleeping well, all those scammers, most of them. So it's not working this side, and we're not doing self-policing. So I think this is where it fails, you know? It's like we don't, the other day I put it like that, DeFi doesn't have a human system. So you can be a repeated scammer, and it's actually a viable business plan. And that's literally the problem, incentives problem. So, you know, and another thing I would add is to your point of are they bad or not, is a lot of them have, I would not assume about their character, but I could just say they do not care about pushing a proper protocol to mainnet. So that was definitely the case on Terra or you know, other things. And just recently, like today, Atomic Wallet got drained, okay, $20 million lost of user funds. It got drained because of a security flaw reported by a guy a year ago. So, you know, here there is no debate possible. Atomic Wallet guys are incompetent and not looking to push a good product. Sometimes it's quite obvious. I would agree with you, there are cases where it's not that obvious. And I would just add that it's not because it's experimental that you can do stupid stuff and, you know, say, oh, it's just an experiment, let's go. I find it's always, it's often a kind of waiver, you know? Like, oh, yeah, it's just experimental, you do you, this can break. But like, it doesn't lift your responsibility of why are you putting this on the network in the first place, you know?
And it perfectly goes into, Primož, I would like to hear your opinion on those, like, to dive into now, like, on the OG protocols and, like, generally, like, in our DeFi space. I want to dig deeper into some of the big maker liquidations that were happening, like, some time ago, even before 12 months. How, like, I'm curious from both of the perspective of, like, a risk, but also how it looks like internally, like, how the teams are managing in these situations that are maybe not like they are systematic risk and it's something how the protocol works, but still those are the risks that can influence and cascadely influence everything else. So I'm curious, like from your perspective, how these things work, how the team manage these situations and so on and so forth.
Yeah, so last year, yeah, it was quite stressful working in DeFi risk, to be honest. I think the most stressful year ever. Actually, for Maker, it started even before Luna UST when there was some first bigger stress test. So maybe some of you know there's this vault power user called 7 Siblings. We actually named it so because he used to use 7 volts, so then it became 7 Siblings. And he's still with Maker. He has 1 billion of collateral, but early last year, I'm not sure when it was, I think January, February, we all, you know, the power users, we always look at them. We have this risk dashboard, we look at their CR, and we see how they behave, right? Because one of our things is to focus on behavior of borrowers, and yeah, it was Friday night. This user just wasn't reacting. There was a crash in the market, but not really a crash, just like Ether dumped a bit. And we saw, he might get liquidated, and his position was 600 million, which, if you compare it with DeFi liquidity, liquidating this amount of Ether could be quite devastating, right? It could lead to cascading liquidations because Ether gets sold, the price decreases more, and then you get other users liquidated, and it can be pretty devastating. So yeah, it was a fun night. Luckily, Maker has this different way of auction system where we liquidate in chunks. It's determined by governance. So the chunk we set, the maximum amount of being liquidated was 60 million. And this turned out to be the right amount because this is something that DeFi liquidity could handle. So every 25 minutes, he would get 60 million liquidated. And the first cycle happened, and then we were hoping for the best, right? Like if this continues, like it drains all the DeFi liquidity, things can turn out really bad. But luckily, this guy, I'm not sure, did crypto Twitter woke him up, but he turned, he topped up his collateral, and only 10% of his loan was actually liquidated, and all was fine. But then we had another problem because, how everything works at Maker, it's predetermined, right? It follows the code. So when this set of liquidations happened, a huge amount of stability fees were paid, and the surplus auctions happened, which means Maker tries to buy MKR at the market and burns it, right? This was at least the case back then. Now the buy and burn is disabled. And yeah, the amount was, again, too big for the market to handle, and we were worried, protocol could be buying MKR at too high price, and we couldn't do anything about it, right? Because it's all predetermined. So long story short, everything was fine. Some arbitrageurs, market makers showed up, and it was handled well, good stress test. But like the long story short, what I would say here is that, even though it's great, like DeFi, you can truly audit in real time what's happening. Like there's no background stuff happening like we saw with CeFi lenders. There's still, this trade-off. Like when this series of events happened, we were just looking really, because any parameter you change at Maker, at least back then, it requires 48 hours to be effective on chain, and that's because to not have governance attacks possible. And we were just hoping all the parameters were set right in place, and we were hoping for the best. And yeah, it turned out it was okay, but it shows you how important this part is, right? It's all public, it's transparent, it's real time, but there's like 12 parameters with auctions. Like if you screw with one parameter, it's game over. So
I feel it. And also, I think when we are touching risks, something that is maybe not immediately obvious, but I think it's important to address is we saw some turmoils with Claros and Aragon, and we were showing generally how, in your opinion, governance is something that is part of the DeFi risks. And do you think that governance is also something that we should take into account when we are calculating the risks, and in what sense? So you can start, and then Bryce, maybe you can add a bit more.
Governance, yeah, definitely. There's a risk with it. At Maker, for instance, we try to do this, how do you call it, lock, when we vote, and then it usually takes, now it takes 3 days actually to have governance vote effective. And we even go that far that it doesn't go effective between weekends because, people are not active maybe. So sometimes it takes 5 days to have on-chain change effective. And it's kind of a drag in some cases, right? Like you want to react, but you can't. So you're kind of optimizing for robustness on governance side. At the same time, you want to react against certain changes. So we're always doing this trade-off, and yeah, it's not easy. Sometimes you need to be prepared in advance. So,
Bryce?
Yeah, I mean, for me, it's like another debate. It's obviously part of a risk assessment. So some protocols can have their code change, and it's done through governance. And then, if you understand that it's part of your assessment. And I would be more explicit in the sense that mostly in 2 ways. So there is the first way, or I would call it the governance modalities, and essentially attacks through governance. So, if they are not careful enough, they don't have time lock or things like that, they might get literally attacked on their governance. So we've seen that on a few protocols where, for instance, assets were drained because they were executing governance was instantly, and one guy managed to one way or another, we're not going to die, but essentially vote like, hey, give all money to myself, boop, done. So, you know, governance parameters are a big thing, but something that people miss also is governance is by definition a long-term threat to the protocol. Meaning that ideally, you want to do without governance if you can do it, but then there are definitely cases where you need governance. So don't make me say what I didn't say. I'm not saying governance is evil. I'm just saying essentially governance should be minimized, is my perspective. So if you can do without a governance, you should really do without it. But then some topics, like I agree with you on Maker, for instance, deciding which assets are suitable to add as collateral, I don't think we have an algorithmic solution to do that in a consistent, proper manner yet, and so it seems sensible to me to use governance to do that. But now you need to understand that it turns governance into a long-term threat to the protocol, because now governance is making calls on essentially where the protocol is heading. And to explicit it a little bit with my love for Maker, but don't worry. It's like, you know, Maker's governance decided to onboard an increasing amount of real-world assets, and that changed the parameters of the Maker protocol, essentially, where now there are those trusted collaterals, meaning you have less guarantees on DAI. And I mean, there are reasons why they do that. It's economical and whatsoever. I'm not saying it's completely stupid. I'm just saying it changed the nature of the protocol. And DAI evolved, and the features of DAI changed because of what governance decided. And so that's just something to have in mind in your risk assessment too, because you know it adds uncertainty towards the future. Essentially, you are assessing something now, but it will evolve, and maybe you will not like the direction it evolves to.
And although like there are like a lot of these moving parts, right? Like so, from one perspective, if you're looking at, we are talking about DeFi risks here, but we can't skip the CeFi in the whole story. And especially because like as we are getting more and more tokenized in the whole DeFi aspects, it is all of these tokens are ending up on also some centralized entities, maybe some black box solutions, so on and so forth. And when the risks are happening, it's kind of like spilling over the whole ecosystem. And Nikola, from that perspective, like how do you see the differences with like assessing the risks with both of the CeFi versus DeFi lending? How do you kind of like perceive that area?
Well, I think that when the risk assessment is concerned in DeFi, you basically just need to take time and to see what's happening on chain before you make any decisions. And when it comes to CeFi, it's a bit more tricky because you don't have so much information which you can use as a to back up your decision, whatever that can be. So I think that we should definitely shift in the lending space. I mean, at least for the lending space, we should shift more to the algorithmic protocols. I mean, the DeFi protocols, because essentially the CeFi and custodial solutions are under the hood using DeFi. They're making their decisions probably based on the data they also find on chain. So I think that it makes more sense to just make some workaround around CeFi and use the DeFi directly.
Okay. Primož, do you want to maybe add, and then Bryce?
Yeah. So that when was it? Like last year or early last year, before all the collapses, right? Particularly Maker, we got a lot of criticism for high liquidation ratios. So not being able to borrow that capital efficiently. At Maker, that specific case, because you have 1 hour Oracle delay to repay your debt. So for users having high liquidation ratio, but this 1 hour delay kind of makes sense. But even if you look at the Aave, the liquidation ratios are still in the range of, or should I say LTVs are in the range of 80 to 85%. And when we do risk modeling, this is usually what works with some simulations. When you simulate price drops, how users behave, what's the slippage on chain, and so on. And we always got a bit of shit of high liquidation ratios. But then, I talked to some institutions and I asked them, okay, so what are your terms at Genesis, right? Because Genesis was the biggest CeFi lender. Like their loan book was tens of billions, 5 times as big as the whole DeFi lending. So they were the competitor off-chain. And they were saying that, yeah, they can borrow with Genesis at 100% LTV. So basically 100, and they can go even beyond, and they have 24 hours to top up their collateral. So of course, in DeFi, this doesn't work, right? And we were surprised, like, how are they taking such risk? And it turns out there were actually few institutional borrowers, real powerful one, like 3AC or Alameda and so on. And all the CeFi lenders were actually competing for these power users, and they were giving them the best loan, the best terms, like totally irrational. But there was some kind of trust, and yeah, it's just insane. Now looking backwards, when we talk to each other, it's insane. But CeFi risk management practices were insane. But I think if they were to be transparent as we were, like I found out about these terms like by occasion, really. But if this would be on-chain, everybody would look at it. There would be like a huge problem. Like people would complain, and maybe they'd solve it. But that's the problem with CeFi. Like it's not transparent.
Fair.
100% agreed, and it's like funny because it was leading me to a point I just wanted to share with you. It's when FTX started to blow up and there were issues on this front, you had quite a few actors that were borrowing both from CeFi lenders and from DeFi protocols. So they had positions on Avi, for instance, or Maker maybe some, but also borrowing from the CeFi lenders. And who do you think they paid back first? That's the funny thing, is they paid back the protocols. Because the protocols, you can't really call the guy and be like, hey, give me a couple more days for the money because I don't have it. Like, you can't do that with Avi, all right? It's a contract. You don't have the money, you get liquidated. End of the story. So I think it kind of shows something to where even those guys understood that, They paid back the DeFi loan, and then they called the CeFi lenders and begged and made the little dance to get a few more days or whatever better terms. But I think it's really insightful to really show that you can't do this little dance with a protocol. And I think that's quite healthy. Going back on the trust you were saying for those loans, yeah, they're immensely trust-based. And I fully agree that if we were seeing those terms publicly when they were signed, they probably would have had massive backlash.
But also, like, Bryce, while we are there, we can't skip, like, stablecoin risks, right? Like, I remember in one moment, like, just chatting with the friends, like, which stablecoin can I hold and not get wrecked, basically. Like, we had depegging of so many of them. We had, like, a lot of mechanisms that were much more risky than they should be, so on and so forth. How do we kind of, like, mitigate, and how do we assess, and how do we approach the stablecoin world right now?
So it's literally a topic for hours. So if you're interested, I did a talk about this yesterday. But yeah, the point I really want to carry out, I guess, is it's just like everything, There is no perfect stablecoin, and so I'm really trying to communicate in terms of making sure you understand the pros and cons of the one you're using, essentially. That's more about this than being like, oh, this is the perfect solution. I mean, there are systems that makes more sense than others, I would say, So like some systems, for instance, are slightly bit more scalable than another, but like 10 times more risky. So for me, it's like not really interesting, but it depends of the people, yeah. Without being too long, just like, I think everybody got the drill on centralized stablecoins. What is a bit harder is the decentralized stablecoins get tricky to assess, essentially. It really depends of what kind of risk you're willing to take. But yeah, if you're willing to trust the governance, for instance, or not, if you're willing to take counterparty risk because you're using a system that relies ultimately on USDC or DAI or Frax, which means essentially dollar in a bank account, or wrapped T-bill or other fun stuff like that. So yeah, it's really like, know the poison you're drinking, I would say.
But it's hard, right? Like, it's generally, like, if you look at our ecosystem, like, you can point in almost any stablecoin right now and find historically the challenges that were happening. Now, almost all of them had like a depeg in one moment, so on and so forth. And Primož, what's your opinion? What's your take on this particular topic, like around the stablecoin risks?
Yeah, I think TokenBrice had a nice presentation 2 days ago, so I think he covered more or less everything. There's this trilemma, I think we call it Pentema. We're all aware of it. I can say for DAI specifically, the focus is on scalability. This means focus is on peg. So, what we're really focusing on is trying to satisfy our liquidity reserves. So whenever you're selling DAI, you can be rest assured Maker has enough liquidity that can be redeemed. So even now when Maker is investing in bonds, there's a framework, and the idea is to invest in the short-term bonds. So there's basically an asset liability management component of how Maker governance now works. So focus is on that. But again, yeah, that's because the main idea is about scalability and back. But as you said, some users prefer something else, right? They want the centralization aspect or something else. So it's a huge market. There's tons of stable coins. People can decide based on their risk profile. So that's it.
Yeah. And also, if you look at any bull market and this hype pressure, hype train that is going on constantly, that also influencing the decisions in teams, right? So Daria, from that perspective, I'm wondering, what's your take on collateral management, or basically decision making on which collaterals are taken into the protocol's account, and also how to ride this hype train as a project, as a team, but not endangering or destroying the vision and the vision of the project that you're a part of.
Okay.
Please go ahead.
No, go ahead then.
Sure.
Yeah.
Okay. Yeah, at Maker we had quite a few. So there's a process to list collateral, like it's governance based, and we did usually risk assessments. And there was a period, you might remember, DeFi 2.0 period, when all the projects became boring and just the shiny new projects became fancy. So we got a lot of shit of not innovating. There were new concepts back then, and there was struggle even internally at Maker. You had some guys who were totally on this DeFi 2.0 train hype, and they wanted these tokens to be listed as collateral at Maker. And yeah, I mean, luckily we have a pretty standard risk framework how we evaluate tokens. There's always fundamental analysis, then you check liquidity, volatility profile, and then technical, of course, if everything is based on multi-sigs, and it turned out a lot of it was based on multi-sigs, you just can't pass the test, right? But there were some struggles, yeah. People really wanted to go with the flow, with the hype, and we said no. I mean, it wasn't really hard for us because everybody, Maker is conservative, so we went conservative stance, and nobody really complained afterwards, and then it turned out, yeah, this was the right approach. But yeah, it's always a problem because people go with hype. So.
Yeah. Daria, your take?
Yeah, I wanted to expand this stand because it's not just about collateral. We as 0x, we see a lot of chains, for example, approaching us to integrate different layer 2s, which there are so many right now. And when it's hype, chains are coming up, new chains, new dexes are coming up, and all they come to us and say we have money, we can pay you, please integrate us. We can do whatever. And we're quite conservative, actually, because maybe now they have users, maybe now they have money, and maybe they have users because they kind of pay to these users to use these protocols, for example. But when the hype dries out, it's really important to see if there is organic growth, if there is if the product actually works, if it brings value. And same for chains do devs actually build on it because it's cool tech and not just because they get incentives. And we're also quite conservative actually, and we try to look at metrics like TVL, monthly active users. There is a really long list down there. And still, even in the bear market, I get pinged by friends, please integrate us. And it's very tough to say no, even to friends. But we need to do this to stay conservative and to be the guardians for our users in a way in the industry.
And Nikola, you guys are all around the collateral, so what's your take on this one?
Well, I think that the conservative approach, I would support it, especially from the stance from the lending protocols, etc. I think that the liquidity, when doing assessment for onboarding some collaterals, or let's say integrating protocols to your platform, I think the liquidity should not be the only parameter you should assess, because, for example, if we take, for example, USD, it was on Aave. So I think you should go deeper and assess the protocol that is behind the token you're trying to add to your platform, because you are essentially representing the safety layer that users can come to your platform and say, okay, if this protocol has been around years, it should be safe to use it and to use those protocol it has onboarded on their platform.
Yeah. And with that, actually, like, let's dive immediately to the liquidity assessment, right? Because how do you see like liquidity assessment as part of the risk mitigations and everything? Maybe Primož, you can after Bryce.
Yeah, just before we get to that, on the risk and integrations between protocol, I do think there are things we could do better. So for instance, I do a lot of governance proposals, and about 6 months ago, I started to do militantism in how I do my proposals. So they are of the highest quality of writing, and one thing specifically I make sure of, they give you the full exposure of risk of the protocol I am suggesting we add, explicited. So, you know, if I'm like, hey, let's do a pair for BLUSD, LUSD, I'm like, okay, LUSD comes from here, here are all the risks that come, you can be, I mean, with LUSD it's very minimal, luckily, and then BLUSD it's a bit more, but you literally have all, okay, so your DAO can trigger this function, unwind would mean this and this happens, so if there is an issue with this contract, you might lose this part of the money, and you know, it's really rare actually to see protocol being explicit on the risk. And it's quite crazy because you think they come to a DAO to ask something like, hey guys, add our token as collateral. Then be like, okay, smart contracts are here, audits are here, you deal with it. No, you tell me what I risk if I add you. So that's kind of like one of the things, yeah, maybe we can do better. For liquidity, yeah, it's not the only topic. I definitely agree. We should look at other qualitative things about the projects, the risk scope, and so on. But yeah, liquidity is also the trap, I guess, people fall into is looking at the present, and that's it. You know, like, oh, there's tons of liquidity now. Okay, cool. But where is it coming from? Who sustains it? Will it still be here in a year? If I kill the whole team, there is still liquidity? If the whole team goes to jail, is liquidity still here? Yeah. You see this kind of question of like, essentially how sustainable is the liquidity? Because that's a big factor. You know, it's really nice to have billions of liquidity, but if they're gone tomorrow when you actually need them to liquidate, it's useless.
Yeah. Primož?
Yeah, I'd say it's a lot about liquidity being sustainable, especially after the whole yield farm era. You know, a lot of that liquidity was not organic, so you need to have this in mind. But I'd say there's another aspect when it comes to liquidity in relation to lending protocols and you know, just overall when you do risk assessment of collaterals, and yeah, liquidity is one of the most important aspects. It's of course on-chain liquidity, right? The AMM liquidity, because when the losses accrue, like worst case, it's all from liquidation events. So when liquidations happen, it's about on-chain liquidity really. If it's sustainable, and what we do when we run the risk models is we look at you know, slippage from aggregators. If you are selling some collateral, what kind of slippage you get, and you apply this in a simulation, you know, you get potentially a loss, and you see how big your debt ceiling should be. And this is the more classic way of estimating risk, you know, for lending protocols. But one thing that maybe some people are forgetting is that, you know, they look at lending protocol and, you know, they simulate 10, let's say 10 million of some ERC20 of being liquidated and apply this slippage, but they're forgetting, you know, DeFi is much wider. You know, you could have leverage of some token across DeFi, right? And when this is getting liquidated, you should actually take that exposure into account and apply slippage on it. And this is what's missing. So for Maker, this is especially important because Maker auctions are slower. There's this 1 hour delay. And when we simulate slippage, you know, it could be that, you know, when we simulate liquidation, that in that hour already a lot of positions unwound on Compound and Aave or got liquidated or other protocols and all the liquidity drained, right? And then, yeah, what's left for Maker unwinding? So we also need to keep this in mind. There's also a way, there's also underestimation of liquidity on-chain, because some tokens, they really truly have most of the liquidity off-chain, for instance on Binance, and a lot of that liquidity flow is coming to on-chain when there's, you know, just through arbitrage. So that's something we're also saying, okay, but it's not so bad that you see on-chain. Actually, some of that flows from off-chain world. So yeah, it's quite complicated, but I'd say one of more important topics when you do risk models for liquidations and so on.
And what about also like on the other side, that maybe it's not super obvious when we talk about DeFi risks in general, but it's like we as a whole community suck at communication. Like it's horrible. Like from numerous perspectives, like when exploit happens, when there is a risk, when we are trying to point out risks instead of like trying to point out things we fight with each other, like every 5 days, like you see like 7 founders like fighting each other on Twitter, like they're like in kindergarten, literally. The level of insults are roughly like 6 to 7 years old. So like from that perspective, how much you think the importance of the communication in the whole DeFi risk is? Bryce, maybe you can start with your opinions.
For me, the biggest problem is not how we communicate, it's the tribalism we see in DeFi. So it happens to me often that I share a perspective on a project, informed and argumented, and I get a hate train of people who don't even read it. They just essentially read that something negative about my coin, attack. And you know, that is a problem. And it's also, I guess, some projects are actively weaponizing this in the sense that, you know, they unleash the community against people who put forward things that might not put them in such a good light in an attempt to silence them. So I will just share that with you. If you see that happen, you know that this project is 99% up to no good. Because I can give you the track record of the previous guys who did that. And you know them all. Do-Kwon, SBF, and so on. You remember how Do-Kwon would address criticism on Twitter. He would insult people. He would be like, your size is not size. Yep. Or I don't care about you. A bit like how Sam addresses criticism about Frax. He will not answer them, or he would say, okay, you're producing a stablecoin for ants. I don't care about what you say. You know, this kind of dismissing statement that literally addresses nothing about the content, and it's all about the Twitter ego game. And I think this is literally like the worst part, because we cannot have a proper discussion. And I guess, yeah, maybe the original scene is we're having this discussion on Twitter, which is optimized for anger, emotion, and reactions, but not for like an actual discussion where we try to think with one another like we're doing now. Yeah,
yeah. Do you, Daria or Primož, do you want to add something on this topic?
Yeah, I'm not sure what I could add here. I agree. I'd say how we communicate risk, at least for Maker, where we do most of the work. You know, every decision that we take, you know, there's an analysis behind it, and we always use a risk dashboard to actually argument every decision. So every parameter change, everything is argumented. And of course, users, when they see that post, they don't know what the hell we're talking. But again, like some users do know within the community, and you know, there's a live audit that can be performed. All our models, everything is open source, so they can see it. So I guess, yeah, that's at least better than what we saw with CFR again. Otherwise, yeah, just in general, communicating risk in DeFi, I don't know, like people are, of course, greedy. They go after the yield, and that's it. They gamble. I'd say, like, if the yield is high, of course, there must be some risk, even though you have cases where, you know, there's yield farming going on, and it's not necessarily risky. But again, it's not sustainable then, so usually it goes lower. I'd say now that the yields dropped, it's kind of, you know, now you truly see what's risky and what's not. Like, you know, if there's like 2-3% yield, yeah, it's kind of, you know, low to medium risk, like benchmark, let's say in DeFi. If it's 5-10, it's high risk. Like, I think people learned now a bit, you know, after all the crashes, yeah, and events, you know, and the market's now a bit more rational than it was.
Yeah, and also, like, if you look DeFi as a whole, like, we can easily say that majority of the DeFi is built in the last 3 years. Like all of the mechanisms, all of the new ideas, new protocols for different types of the things. And still, like, whatever we call some of these projects even OG now, and they're like maybe 3 years old. And it's really interesting how we are forgetting how young the whole industry is, how totally new all of these things are. And with that in mind, Daria, what's your opinion about is DeFi ready for this cliche question now? Like, is DeFi ready for this mass adoption, or should we take it down a notch? Should we approach it in a different way? What's your take on that?
I would say we should take it slowly, because I have like for example, 2 years old nephew who is like already very good with iPhone, and I'm sure he will be DeFi native, more DeFi native that I will ever try to be, because he is basically born with like computer, he is born with like, and I will explain him crypto in a few years, basically. But the idea is that when it comes to mass adoption, it takes, it's like on the side of Web 2 or Web 2.5 companies, at least for me, because still they have user base. And this means we are talking about companies like Google or like Apple or like really big names. We work with one of such names, Robinhood, for example. It integrates 0x in its wallet for swaps. And basically, Robinhood in States has like, it's fintech who has 20 million users. And when we started working with them, one of the big questions for us was like, how do we do it? What happens if all these millions of users suddenly becomes like DeFi native? And they all go on Polygon and start swapping on Polygon. How do we solve for this? And basically, the result was a newly, like fully redesigned product for like gasless swaps that we kind of introduced just recently. So I feel like DeFi should like first figure out the basics, and the next step you need to figure out the scale, and that's what we've been doing like with these big players. But many more will come. Obviously, there is like huge enterprise interest right now, especially after FTX as well. Like people are a bit cautious about CeFi, but they really want to go into DeFi. But this means like cycles of years, like at least 1, 2, or like 10 years for them to actually go into industry. So yes, we will get there, but not immediately.
Yeah. Nikola, do you have anything to add there?
Yeah, I would agree with the statement that from the user's perspective, we should take it slowly. Because DeFi tends to move fast and break things. I probably should give an example. For example, if we have some Oracle attack on some DeFi lending protocol, you'll be seeing, let's say in a month, a completely new, brand new lending protocol saying, well, if you have used us, that would not happen. I mean, offering a new type of solution for what has happened. And I think that DeFi actually tries to bring people in and to test things that are completely brand new. And that's why I think we should take it slowly, and that for a mass adoption, we first need mass adoption of knowledge sharing and the mass adoption of the UX improvements, and literally just starting from explaining to the people who want to learn more what is like an Ethereum account, and what are the types of those, what can you do with those, and etc. So yeah.
And also like the last part that I wanted kind of to hear the question from multiple of you is, some of the primitives that we are building right now in this ecosystem are super important for the society, but it's hurtful for people that are in the power, in different governments, in different countries, different entities, so on and so forth, right? And we already saw that some of the people were hurted because they were public, they were a known figure by the name, by surname, where they live, so on and so forth. How do you perceive the anonymous culture, and how in the importance of the anonymous culture inside of the DeFi ecosystem? Maybe Daria, we can start from you. Like, what's your take on that one?
Yeah, sure. So basically, like building on like mass adoption topic, for me, I think there are two angles here. The first angle is innovation. So if you want to be on the edge of innovation, it's probably better to be anon, and because regulation, frankly speaking, is not always supportive of innovation in many countries. So if you want to build like the newest stuff, then it's probably not to disclose your identity too much, at least from my side, or live in super friendly, crypto-friendly country, which there are not so many of those. At the same time, if we're talking about mass adoption, again, you coming back to enterprise clients, if you will be like some 0x Daria even on Twitter, they won't talk to you. They will be like, who are you? Why should I do business with you? And like, why should I trust you? Because all like Web2 business, you need to speak their language.
Yeah.
So this is, I guess it's up to you and up to each project to decide where you stand. Like for 0x, because we end up being gateway between like Web2 world and Web3 world, we're kind of in betweens. So for example, in our DAOs, there are like people that I don't even know the gender of them. I asked once, just not to be sure how to address a person, and she was like, or he was like this person was saying me like, basically, I want to stay anon, and that's it overall. And I was like, okay, it's like if the person wants it, then I should like be okay. But my team members, yes, I know by names and I know where they live overall. So it really depends.
Yeah, Bryce.
Yeah, just building up on this. For me, anonymity is absolutely essential component of the crypto culture. And it's what makes it significantly different. So you know those themes of accessibility or having enough women or making it friendly to transgender or people from all around the world. Thanks to anonymity, they're essentially a non-topic. Because an anon, you don't know his gender, you don't know if he's Palestinian or Israeli, and you don't like this country or whatsoever.
Yeah.
And you know, we've seen that a lot. And what's disappointing is when the mask goes down. So you know, like for instance, some guy, DeFi advisor, who knows him, is like, most people, they just say like his takes on Twitter and stuff, they don't know who he is. And then one day he got on your panel, and from his accent, one guy could tell he was Israeli and had a problem with that. You're like, you know, this is...
But also interesting to add there is like Sifu situation, okay? So he was like, people went nuts when they realized the connection between that person and a real human being that was already into some shadowy things. So from that perspective, like, where is the border, in your opinion, between shadowy anon and shadowy supercoder anon? Like the positive anon side and the negative side? Because if people did not know who is Sifu, he could spin out something again as an anon again, and people would maybe praise him all over the thing.
Share a ball with you, because you guys did something interesting. Is there is anon and anon, you know. There are guys who are anon, and it takes me 10 minutes to know who they are. And there are guys who are anon, and I tried for 4 hours, and I still don't know who they are. Those are not the same anon. And in that sense, Maker did something about the delegates for that, where they like go try to dox them because they want to make sure they are actually proper anon, you know.
Yeah.
And I would say an anon you can dox in an hour, you should probably forget about this guy altogether. You know, he wasn't able to set a proper OPSEC for his anonymity, which is the core thing he's doing. So don't think he's going to be able to push Solidity code or grow a protocol. This is not going to happen. Yeah, and I guess just on what you were saying, institutionals are nice and dandy, but remember they're also immensely stupid. One of the worst risk analysts of the space, and they come with absurd ideas, like they don't want to talk to Anon, and they want all kinds of things that are, you know, insanity for crypto people. So I would say we're literally right now, I would agree we're not at the mass adoption stage, but we are at a critical moment. Because essentially it's, do you let those institutionals seize that space like they did with the internet 20 years ago, or do you join with us and marry, build together? And I think it's really the best time to come around, get involved, and build. And when we say build, let me explicit that it doesn't mean necessarily coding, okay? I don't know Solidity, and I still call myself a builder, because I build communities, I build integrations, collaborations, many things that do result in more adoptions, more people getting involved. And for me, that's equally as important, if not more than the code. And just to wrap this up, I guess it's also a bit counterintuitive, because all of we say and build is about trustlessness and decentralization and so on. But the more I go, and now it's been 5 years I'm in this space, and the more I resort back to very simple thing. I want to work with decent human beings, and I want to see them being passionate about what they build. Because at the end of the day, just like everything else, just like why is Bill Grady so freaking cool, it's because it's done with a soul. The organizers have a soul, they have a spirit for what they want to do, and they put love in what they're doing. And this is how you build great things. It has a soul, and you throw love to it. At the end of the day, even for code, you need love.
Perfect wrapping up here. Okay, I'm wondering, anybody from the audience, we have maybe time for 1-2 questions. Is there anybody that is excited to ask questions, any of our panelists? Yeah, I don't see, so they will help me out. 1 or 2.
Hi, a quick
Pinky
question
promise.
from me.
one quick question.
Okay.
So before
Okay,
we
well,
switch to the next speaker.
Go ahead.
Primo mentioned that when you look for collateral for Maker, you create a risk analysis through a number of fundamental research first, then alternative research. I just want to ask you if there's an open source database of your methods that you use for you to create a scoring of these potential collateral. And I know that you work on Project Levan for credit on individual wallets. Do you have an open source list of ratings for projects that you're looking
Sorry, I cannot hear well, to be honest.
I think he's asking like the collateral assessment on Maker. Where is the data? Can you find like the framework and things like that?
You're asking about collateral assessment at Maker?
Yeah,
The
how you
framework?
do it, if there is an open source method that you use, and if you're trying to transition Project Levan from individual wallets into projects that you are also looking to add as a collateral for Maker and many other projects.
Sorry, I think I lost you again. I'm not sure. I'm not hearing well from this side. So there are, how we add collateral, it follows pretty standard template. Like if you go at collateral assessments at Maker, it all follows same path. So you could read more about it there. But there was a follow-up question I didn't get, sorry.
Unfortunately, we are out of time, and I want
Sorry.
to thank you all for
speak
participating in
outside.
this panel and having an amazing talk and sharing your knowledge with our audience. So can we please get a huge applause for our panelists?